What is up, everyone? It is Dividend Grinder. Today is April 2nd, and today's video is all about my portfolio and the allocations associated with the portfolio. Kind of like a deep, comprehensive breakdown of the sectors, how much I'm contributing in the dividends, so on and so forth. So right now you're just looking at the homepage of M1 Finance. You can see $21,058, absolutely incredible. A money weighted average return, 16.1%. We'll never complain about everything being in the green. As you can see by the multiple pies and GLPI, everything is in the green. And my top holding, which is gaming and leisure properties, which is 20.2% of the portfolio, is at 5.35% in the green. So the portfolio is still riding that nice sale of Gladstone Commercial Corp for a little around $900 to $1,000, and then we are growing it from there. Everything is working out so well. So speaking of percentages, let's go over to Excel. And by the way, if you did not know this, because I do not have Microsoft Office on this computer that I record on, if you have an email address associated with a university, a college, whatever it is, secondary education, then you can actually access Excel online for free. You just have to type in your address. I forget where I go. I've discovered this a while ago but never used it to record a video, but here we are. I am on Excel online without Microsoft Office on my computer. So let's get right down into it. So yesterday I made a video of dividend downfalls, and obviously a lot of dislikes. There's already 6 dislikes as I'm making this video, but whatever. Half of them probably didn't even watch the video. So is it true? Am I switching over to growth? Well, the proof is in the pudding. If we go to the pie on the right here, you can see 99% of my holdings pay a dividend or distribution of some sort. It's actually higher. It's 99.07. I don't know if you can see it there. So only 1% of my overall portfolio does not pay a dividend. And how am I calculating these? So I have my cost basis up here. So $20,590 in my cost basis for the portfolio, and then I divide it by the cost basis for whatever holdings fit the bill. So as you can see on the dividend side here, I have every single stock that pays a dividend in my portfolio. I have the cost basis for each, and then what do? I take the sum of the cost basis and divide it by the total cost basis, and that gives me the percentage of the portfolio for whatever segment that I'm talking about. So this tab right here, very easy, very simple. Dividend versus non-dividend payers in the portfolio. 99% of my portfolio pays a dividend, and it might honestly be a little bit higher than that if I never did the subscriber pie. In fact, I know for a fact it would be higher than that. The only 2 stocks that I own that would not pay a dividend that are completely my choice are Amazon and Google, and I have no problem with those not paying a dividend. So that's dividend versus non-dividend. Clearly, dividend dominated portfolio. So proof is in the pudding. I'm not going anywhere. Next, we look at monthly dividend and quarterly dividends. So of my 99% of the portfolio that pays dividend, what percentage is allocated monthly and which is quarterly? So this one starts to diversify a little bit, but unlike a lot of mainstream portfolios, mine is dominated by monthly payers. And this is illustrated, as you know, I have a monthly Mania pie, which it's about, I forget off the top of my head, but all of them pay monthly. So 78.5% of my portfolio pays monthly, 21.4% pay quarterly. I would like to get the quarterlies up a little bit more. And of that 21%, about 20% of it is gaming and leisure property. So it's all coming from one holding, but just an interesting little breakdown. So 79% roughly of my portfolio is in monthly dividend payers. Next is risk allocation type, and this is where it starts getting interesting. You see a little bit more bigger breakdowns. So we divide the pie into 6 slices. And this is where you're going to see a lot of odd things that I consider odd. Maybe you don't. Maybe you think it's a little too conservative. But 47% of my portfolio is in the category of monthly bond, short maturities, floating rate, etc., etc. Items such as that. That is 47% of my portfolio. Very, very conservative in my opinion. I would honestly like to get that number down to about 40%. We move on to the next highest section, and that is the quarterly REITs. And this is pretty much just gaming and leisure properties, 20% of the portfolio. The next highest piece at 19% is monthly REITs, business development companies, and funds. And what I mean by funds, if we go over here, I have this broken out. BlackRock Science and Technology Trust and Invesco High Dividend Yield REIT ETF. So those two funds I've included in the monthly REIT, BDC, and funds allocation. So that is 19% of the portfolio. Moving down to 12% of the portfolio, we have monthly total market ETFs. And what comprises these is only 3 holdings. It is the S&P 500 High Dividend Low Volatility Fund, the S&P 500 Low Volatility Fund, and the ticker symbol DIA, the Dow Jones Industrial Average SPDR Fund. So these encapture a lot of the market. So I label them as total market ETFs, and they comprise 12% of the portfolio. And then paltry percentages at the bottom are pure growth, which I believe is less than 1%. And the other piece is traditional quarterly dividend payers. So if we go to pure growth, you can see of the cost basis of $20,000, $20,500, only 192 cost basis is in pure growth stocks. And these include Google, Amazon, Tesla. Duke Energy should not be in there. I don't know why. So it's actually even less. Then we have Facebook, Yext, Micron, Square, and Shopify. Those are classified as pure growth for this purpose. And then the traditional quarterly dividend payers, only $244 out of the 20,000 that are in the cost basis. And you can see there's Duke labeled twice. I don't know why I put it in underneath. But Archer, Stanley, Midland, Southern Comp, Office Depot, Nokia, Synchrony Financial, GE, Altria, AT&T, Coca-Cola, AbbVie, A.O. Smith Corp, Visa, and Microsoft. And the rest are mainly in the other segment. But as you can see, this is very interesting. 47% is in very short-term maturity or bond ETFs, very conservative allocations, very low volatility, which brings us to our next tab. So it's the volatility tab. So I have a low volatility versus a normal fund. That's it. I didn't go like medium versus high volatility. I went strictly intentional low volatility versus normal stocks. And as you can see, 56% of my portfolio is low volatility. So I really took that conservative step to the next level here. 56 is very large portion of the portfolio to be low volatility. Low volatility is pretty much very low risk. At least that's how I assess it. It's as you can see, it's pretty much all of the bond ETFs, the short maturity ETFs, etc., etc. We also have the S&P 500 low volatility. We have the S&P 500 high dividend low volatility, ticker symbol SPHD. So that makes up 56% of the portfolio. It's one of those things that you can just keep putting money into. If you're looking for value, but value's just not coming, you could always just dump money into this segment and you're not going to lose that capital appreciation. And if you do, it's extremely minimal. That's the point of low volatility. You want to get it as flat as possible while still getting some monthly or quarterly returns from dividends or distributions. That's the point I made in this portfolio. 56% of it is low volatility. In my opinion, I would like to see that number be driven down a little bit, closer to 45% for low volatility. So very risk averse. So if we do go towards a market downturn, I know that at this moment, if the portfolio were to stay the same, 56% of my holdings are relatively safe against some kind of recession. Obviously, they will take a dip. It's not like bond ETFs stay perfect through bear markets or recessions. They will dip a little bit. However, they are greatly more reliable than a normal stock with normal volatility. I even put all of my REITs in the normal category, even though some of them are pretty low volatile. I put them all in the normal category just to illustrate to myself that, hey, you have a ton. In fact, more than 50% of your portfolio is involved around low volatility funds. Speaking of REIT, let's go on to that. So how much of my portfolio is in REITs? And this is also an alarmingly high number that I'm glad I did these breakouts for. So 31, whatever, the rounding's fine. But 31% of my current portfolio is in REITs. And I don't even own too many in terms of number of holdings that are REITs, but They are GLPI, STAG, EPR, Realty Income Corp, LTC Properties, Gladstone Land, Invesco High Dividend REIT ETF. I put it in there because it's all about REITs, and New Residential Investment Corp, which is a very tiny amount of $11. GLPI is huge at over $4,000 of cost basis, and everything except for New Residential and Gaming and Leisure Properties is a monthly paying REIT, but nonetheless, they are REITs and they comprise 31% of my portfolio. I would like to get that number down. I would like to get it around the 20% mark. That would be ideal for me. I do love REITs. I love their high yields. I love that they have a lot of monthly paying options. So I don't want to like get rid of REITs completely or anything, but I would like to drive it to 20% of the portfolio or something around there. Get a little more volatility in my portfolio, as you saw by the last tab, and also diversify away from REITs. I believe I have enough into real estate that I don't need anymore. Now, when I say I want to lower 20%, I do not want to sell any of my current positions. I don't want to get rid of any shares. So when I say lower, I mean I just want to start allocating my funds, my daily deposits, into more diversified holdings. Something that's not low volatility, something that's not a REIT. I can go the traditional quarterly route, the traditional dividend aristocrats. Maybe I'll add more growth stocks, which, by the way, growth stocks will never, ever pass more than 15% of my portfolio. I am the dividend grinder. I believe in them. They are true to my heart. So I will not go less than 85% of my total portfolio in dividends. Right now it's at 99, not even close to touching that number. So 31% REITs, looking to get away from the REITs. I have enough coverage there. In fact, you might argue that I have a little bit too much leverage. That's fine. Most of that's coming from gaming and leisure properties. And the final tab, which is very close to the risk allocation tab, we have a complete sector breakdown. This is broken out by REITs, the short maturity bond ETF floating rates, the monthly BDC and funds. We have a monthly total market ETF, and then we have the tech and internet square, and then everything else is lumped into other. So again, you're going to see that huge portion of my portfolio going to short maturity bond ETF and floating rate, and then 32% is in REITs. It was 33%, I believe, on the actual 31%. So it's just rounding, but 45 plus 32, what is that? 77% of the portfolio is either a REIT or it's a short maturity bond ETF floating rate, etc., something that's very low volatile monthly paying. So 77%, that's a very large number. I want to start diversifying a little bit more, drive these numbers down a little bit, but again, I do not want to sell any positions. This is just eye-opening to me that I need to diversify a little bit more, maybe add a little more risk into the portfolio. 12% goes to the total market ETFs, which again is the S&P 500 low volatility, S&P 500 high dividend low volatility, and the Dow Jones Industrial Average SPDR fund, ticker symbol DIA. The next largest chunk sector is 6% going to monthly business development corp and funds. And this includes Main Street Capital Corp, Gladstone Investment Corp, Shaw Communications, and BlackRock Science and Technology. These are monthly payers, and I included them in the monthly BDC/funds sector. The next highest is the other category because tech and internet, despite me having new positions in them, only makes up 1%. And I have a number of holdings in there, however, they are very low funded. So under the tech and internet, I put Google, Microsoft, Amazon, Nokia, Facebook, Yext, Micron, Square, and Shopify into that segment, very NASDAQ oriented stocks. And then 4% for all of my other holdings. So this has been eye-opening to me. It's something that I suggest you do if you have not already. Do a sector breakdown of your portfolio. Are you diversified enough? For me, this is a very safe portfolio, so I'm not embarrassed or anything to have such a high number in the short maturity and bond section of my portfolio, but I would like to diversify a little bit more. I have a lot of REIT coverage. Even though I love REITs, real estate investment trusts, I think it's time to move on from them, not sell off in my position, but really start diversifying into other market segments. Let me know if you like this video. I think the pie charts actually help a lot into just give me some perspective. Even though I am colorblind, the charts help out a ton It's very interesting to see the breakdowns of the different types. So this one was just dividend versus non-dividend payers in the portfolio, the monthly divs versus quarterly divs, risk allocation type, volatility, REIT percentage, and the sector breakout. Most common, I would say, is the sector breakout. There's also the dividend versus non-dividend payers. Obviously, a more logical portfolio is going to have less than 99% dividends. Some of them will have 100%, but a lot of them will have less than 99%. So that's also a good one to look at. Diversify between dividends and non-dividend paying holdings. This has been the Dividend Grinder. I hope you enjoyed this video. Let me know your thoughts if you do breakouts like this, if you like videos like this where I do complete breakouts. Let me know if you want to see any different types of videos. I'm always interested in hearing that in the comments. Thank you guys for giving me another month of getting paid from YouTube. It's going to happen on the 21st of this month. That's usually when the payouts date, but it's for much. Thank you very much. If you haven't, go on the post in the community section on my channel and vote for where that $100 will go. The subscribers get to choose where it goes into my portfolio, just so you have some stake in the action. Makes it a little bit more interesting for the viewers. Thank you for watching. I will see you guys and gals in the next one.